Hello guys, welcome to my channel. Today we will dive into a concept in finance and investing that is called equity. Okay, whether you are a student or investor, you should know what is equity and how equity works in day-to-day life. Okay, so some of us might be investing through the equity market. We might buy stock, we might buy some bond or other financial security to invest our savings and to generate some return on that. So it is very evident or very relevant for us to understand the different financial concepts. So today I will explain you what equity is and how this equity market works. Okay, so equity simply means ownership. Okay, in financial world, equity represent a value that a owner has in a particular company. Okay, like you own some asset or part of a company. So basically imagine you have a 50 lakh rupees or maybe more than that. So you want to invest in some company, you selected some company like Tata or MindMatrix or some other. Okay, so you invested it, so you put in your 50 lakhs of rupee. So that uh, 50 lakhs of rupee represent your ownership in that particular company. So you will get some shares, and that will represent your ownership in that, and that equity share will be traded on stock exchanges if those are public limited companies. Okay, so that is all about equity. So so that was equity thing. Okay, so I'll explain you in more detail. Okay, so equity basically, if you see, so equity is like uh, the return to the shareholders if asset are sold and debts are paid by the company. Okay, it reflects a residual ownership, like you are owner of that particular company. Okay, what is remained after paying out liabilities and all. So basically, okay, so if you want to calculate your equity, so that is like total asset minus total liability, then you will get the equity value of that particular firm. So that equity value of that particular firm is divided by number of shares, then you will get a book value of your per share. Okay, that is how you come to equity value of your company. So return on equity is the most important ratio which an investor should look for before investing in any organization or any company. Okay, so that is the basic terms we should know it. Coming to book value and equity market value. So book value is like the amount of money which I gave to the company with I mean described amount like 10 rupees or 100 rupees per share. Okay, so that was my initial investment. That will be my share capital, like 50 million I invested with 10 rupee, and I'll get 50,000, so 5 lakhs of shares. So that is 5 lakh is my shares, and then it is multiplied by 10 and it becomes 50 lakh. That is the worth of my equity. So that is your book value. Market value is derived by number of shares into the share price. Like if I bought it at 10 initially, and then it fluctuated through the trading volumes and all. From 10 it became 11 or 12 or 13, whatever. So that multiplied by your number of shares will become your worth. Okay, for example, uh, today is your worth. You have for example 1000 shares. Okay, 1000 shares, and market price became 12 after purchasing at 10. Okay, 10 INR. Okay, so it becomes 12 now. So what will be your worth now? It will become 12,000. Okay, so you bought at 10, it was 10 into multiplied your number of shares, so it was worth of like 10,000. 10,000 initially. Now your worth has become 12,000. This is the market value. This is the market value. Okay, so this is what how we calculate share price into number of shares. You had number of shares is what? 1000. This is just an example. This is how you come to know the value of your equity in particular organized company. Like I bought a Reliance, or by I bought some other company shares, TCS or Tata, or maybe IRCTC company, I bought it. Okay, that is how you derive your market value. Okay, now coming to equity. So there are certain features of that equity. So equity is like, own fund. I mean, investors are investing their own money in the company. You become owner, so that is your own fund. Okay, if you uh, I mean get some funds from outside of through the institutional bank or institutional investors like uh, banks or some other non-banking financial corporations or some other lending firms, then that fund become a debt to you. Okay, and equity is like, investing your own money. So stocks is represented through equities. Okay, that is a piece of ownership in your firm or in particular firm. Okay, in kind of real estate, that is also a equity kind of things where you buy a house or something, that is called a home equity. Okay, that is the home equity. Okay, in business, if you invest your own money, then it is your owner's equity that will represent any liabilities or any asset they have bought it. So this is overall equity term definition, that how equity is and what is equity means and how debt works and what stock represent in a particular way in a particular firm. Okay, that was about definition of equity. So the feature of equity market, so like I said, equity has a different features what can be used by investors or the maybe for the companies. Okay, it is used to raise a capital. Okay, first, as a owner of a company, I have an opportunity to raise a capital. Okay, if I go on market, equity market, and I need money with a the cheaper rate, I will issue my company's shares and raise a capital. Okay, that is how you raise a capital. That is the most important feature of equity market. Then this is help to increase the liquidity in the market. How? For example, your stocks are listed, people can have an open market. Okay, open market where they can buy and sell shares of a different public listed company. So that is how there is a liquidity. If nobody can buy or sell, then there is no liquidity. Okay, it helps to economy active. Okay, for example, if people are investing, companies are getting money, they are investing in products, they are expanding, they are acquiring new firms, increasing in their product line, generating more revenues, then distributing it to their employees then spending in economy, like buying on particular stores, they buy product, they spend. So that is how economy runs. Okay, and then investment options, like I have a lot of money, I don't do, I have nothing to do with that money, instead of keeping it idle, I can use that money to invest in stock market. So that is how you get a investment opportunity. Okay, that was about features of equity market. Now we'll talk about the what equity market is. Since you know what is equity, how it represents your ownership, the how can you invest in equity market, what are the different features of equity market, now everybody will wonder what is equity market now. So equity market is a kind of a platform, or I can say it is a market where two different people comes, they buy and sell particular ownership as. Okay, for example, a person has money. For example, Mr. A has a money and Mr. B started one company which sells shoes, and he needs money for expansion of his business, or you know to do some investment in machinery, etc. So what he will do, he will go to bank. Okay, but he doesn't want to loan, I mean he doesn't want to keep his company as a mortgage and get some money to expand his business. And obviously banks will give you the loans with higher rate of interest. So, okay, so nobody will like or would like to go for a loan with a higher rate of interest, and eventually you have to pay the interest rate every month. Okay, or every quarter, depending on your contract with the lenders. Why? Unlike, unlike these debt, equity market is very flexible. where in companies or any individual firms can go list their uh, company and raise capital, okay, without giving a promise to the investor that every month they will get a fixed return. So it is not like that, okay. So what will happen, company will raise capital. What will they issue? They issue of certain shares or stocks of their company. So that will represent ownership. For example, as a owner I have a 5,000, and company issuing share as 10, then I will have a 500 shares of that particular company. So that will represent my ownership, and I have the shares of that company. So company will not be obliged to pay me every month a return or any kind of interest, okay. It will be flexible to them, and I will have an option to have a two kind of income like dividend or capital gain and loss. So the prices if goes up, I will have a capital gain on that. If I want to exit the company, I can sell that shares in equity market and then get my money back, and somewhere else I can invest it. That is how I will generate profit also. If I invest just 5,000, I might get 10,000 also, 12,000 also, or I might lose my money also if stock market is not working well for me, or maybe the stock of that price is falling down due to low demand and all, or maybe the company is not making profit, because of that is impacting the share price of that company. So I will make a loss. So that is how it works. So this is your equity market, okay, where a company will be there who will issue a shares or stock, okay, to an investor who has lot of money. So what will happen, investor will buy this stock, company will issue a share, they will raise a capital for their expansion, and this investor will get a ownership or a stake in the company, okay. So that is how your equity market work. So this is all about equity market. So I hope I was able to explain you what equity market is, what equity is, and how you can differentiate between the equity funding and the debt funding, and what are the benefit of equity market or equity funding benefit or a debt benefit, okay. Hope you like the video. Please subscribe to my channel, okay, for interesting videos on these financial terms. Thank you so much.